Good afternoon, everyone, and welcome to Scotia iTrade webinars. Today's topic is on options trading and volatility with the Montreal Exchange. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your control panel. And if you are experiencing audio difficulties, you can always click on that sound check link, or sometimes it may show up as a settings link in your audio panel as well. And thank you, Diane, for confirming. So if you're experiencing audio difficulties, the setup window may show up on your secondary screen, and everyone is muted for sound quality purposes. And if you did join using your computer speakers and find the audio still not great, you're also welcome to use your telephone by dialing in, and also don't forget to enter the access code as well as the audio PIN ID. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. And we did get a chance to use this control panel. I do want to note that the GoToWebinar platform does automatically hide the control panel for you at times. And if you do want to show it, you can just simply click on that arrow icon to expand it. Also, you are welcome to view in full screen mode. And also, you may click on the hand icon at any time if you have any questions, and also type them in the question panel. And our presenter will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. You may also access our past webinar recordings on our Webinars on Demand page under the Learn and Do More section, or if you didn't get a chance to request a copy of this recording on our registration page, you are also welcome to email us at education@scotiaitrade.com to request a copy. And you are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that the handouts panel is not currently visible, but will be so at the end of the session. And today's session is part of a Montreal Exchange Options Learning Series. Options Trading and Volatility is part of Series 3, Mastering Options. And if you didn't get a chance to preview or view any of the past sessions, you may also view them from our Webinars on Demand page at any time to catch up. And your presenter today is Jason Ayers. He's been an instructor for the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He's a derivative market specialist by designation. Welcome, Jason.
Hey there, Rose. Thanks for having me on today. So we're going to just do a screen share here, and I'll invite you to also just indicate in the control panel as to whether or not you can see my screen. So we're just going to make that switch now. So at this point, everybody should be viewing the title slide for today's presentation, which is, of course, Options Trading and Volatility. Once again, just please, by all means, indicate in the control panel, if you can, that you're seeing that. Good stuff. I'm already getting some feedback in the Q&A box. So let's get underway here. So once again, we're going to be looking at options trading and the impact and considerations that market volatility and options volatility has on our decision-making process. To echo Rose's sentiments, so we just want to make sure that everybody understands that today's presentation is for educational purposes only, and any of the examples that we're discussing here during today's presentation should not be taken as advice, really, again, just viewed as you know, for educational purposes only. So first thing that we want to tackle here is just discuss why volatility is important. In fact, I think an understanding of volatility is probably one of the more important considerations for those of you that are just starting to embrace the options market. Has a significant impact on you know, position management, strategy selection, and so we want to make sure that everybody has a good understanding of the concept of volatility. I'm going to talk about how we can offset volatility utilizing debit spreads. Of course, we have done more in-depth presentations on the debit spread strategy in the past, so I invite you guys, if you want to learn more about debit spreads, to certainly go back into the archives and review. We're also going to talk about selling volatility as well, and once again, we've got a number of other presentations that focus specifically on options writing, and I would invite you to to look to those for further information once you've gone through today's presentation. So why is volatility important? Well, volatility is essentially an adjustment for risk. And what we want to recognize is that options are priced based on probabilities. And so what's happening is that market makers are essentially factoring in risk and probabilities within the pricing of an options contract, and that actually equates to the increase or decrease of the volatility component of an options premium. So implied volatility can be impacted by company earnings, because company earnings, of course, reflect an uncertain condition within a particular stock. The implied volatility of an option contract can be impacted by a pending announcement or merger. Once again, there are unknown variables associated with certain announcements that are going to be made based on a stock. In terms of mergers or acquisitions or product launches. And finally, and probably the most prevalent over the last little while, is just a consideration for economic or market risk. So again, when there's a general consideration that the market is going to be more risky, then you will see an increase in implied volatility. When there is less to be worried about, you'll typically see a decrease in implied volatility. So I always try to get people to think of this like an insurance policy on your car or your house. When the insurance underwriter believes that there's no risk associated with your driving or with your business or with your house, then premiums tend to remain relatively low. But as soon as there is an increased risk or uncertainty associated with what's being insured or what is being underwritten, then subsequently those premiums will increase. So that's what essentially happens within the options market as well. So there's two types of volatility that we're considering when we're looking at a stock, the overall market, or an options contract. The first is historical volatility. Now, historical volatility is quantifiable. We can measure that fairly accurately because it is a function of past realized volatility. So basically what happens is that the average deviation of the share price of a certain security from its average price is calculated over a period of time, and that is then what is presented to us as the historical volatility of the stock. So, one way that you can look at this, for those of you that are somewhat familiar with technical analysis, is if we plotted, let's say, a 20-bar moving average on a price chart. Well, we know that the price of the stock will sometimes be above that 20-bar moving average, and it will sometimes be below that 20-bar moving average. And so historical volatility is really measuring just how much above or how much below the price of the stock is from its average. Now, it's important to understand that historic volatility, or volatility in general, is really not necessarily a function of direction. So in other words, just because a stock has a high historical volatility, it could be because the stock has moved significantly higher from its average over a period of time, or it could be because the stock has moved significantly lower over that period of time. And so it's really not a function of direction at all. It's more specifically a function of just the price deviation. Now, when it comes to the options market, this is where we're considering implied volatility. So if we think about the word implied, we could really, replace that with anticipated. So anticipated volatility. And so what happens is within the options contract, there is a factor priced in based on the market's expectation for future volatility. So once again, a stock may be sort of trading along at its, the way it's expected to trade based on its historical volatility, but the implied volatility factor of that's priced into the option contract may be significantly higher. And what's happening is that the market and the market makers, more specifically, are pricing in an anticipation for the stock to move, or for the particular security to move significantly over a period of time. So it's the probabilities adjustment for the options price, right? And the more uncertain the markets are, or the more uncertain a specific event is that may be taking place within the life cycle of an option contract, the higher the implied volatility variable will be within the options contract. So what's interesting, and we won't get too mathematical here, but what's interesting is that creates what's known as a probabilities distribution curve, right? And so what we hear is sort of what we would refer to as a normal distribution curve. And what we're considering is that if the stock is at $50, the market is pricing in a 34.1% chance that the stock is going to be below 50, and a 34.1% chance that the stock is going to be above 50. And then you can see that the probabilities will decrease the lower and the higher, or the more above or below that particular current price of the underlying security. So the expectation would be that if the stock is not expected to do anything of any great significance, and if it's expected just to sort of move along at the same pace that it has been, the same historic volatility that it has been, the market maker will essentially price the implied volatility very close to what the historic volatility looks like. And so when they're pricing options, they will essentially be looking at the market or looking at the stock and saying, okay, there is a 68.2% probability that the stock is going to remain between $45 and $55 within the life cycle of the contract. So this consideration is very important, because what it demonstrates to us is that a market maker, which we've talked about in our past in some of our past videos, the market maker really does not have a directional bias for a particular stock. The market maker's decisions are based on the demand, the demand of the market participants, and the volatility of the underlying stock, or the historic volatility of the underlying stock. So in this case, under normal circumstances, it would be expected that the stock is going to trade within a particular range within that time frame, and the options would be priced accordingly. But what happens is that as market conditions change, and as new information is being released or considered, we may enter into a period of anticipated high volatility. So in other words, if all of a sudden there's, for lack of a better example, let's say there's some major geopolitical event, or something very significant that catches the market off guard, well, that would reflect in an increase of volatility, or of implied volatility. And what happens is, as soon as implied volatility expands, it actually influences the price of the option contract. Now, this rate of change is referred to as the vega, and again, we've actually talked about this in our options introduction to option Greeks webinar, where each of the pricing variables associated with an option contract is given its own Greek name. So for implied volatility, it's referred to as the vega. And so what happens is vega increases and decreases as a function of this adjustment in implied volatility, and then that is used in the pricing equation for options. So the vega of the option contract would be factored in to the mathematical pricing model, and typically it's the Black-Scholes model that's utilized, Vega would be factored into that model, and then an adjustment would be made on the option premium. So what happens then is when implied volatility expands, what you'll see now is that the market maker is saying, okay, now there's a 68.2% probability that the stock is going to trade within 42 and 58. So you can see how we've widened that center zone. So what that means is that all the option contracts above and below the current stock price will be adjusted accordingly, right? So you can see that there's what I would call a ripple effect. So when the at the money options that are basically centering around the current underlying value of the security, when they adjust, the other option contracts out across the distribution curve will adjust as well. And what that means is that we will end up paying more for those contracts because of this expansion in implied volatility. So that's something we have to be very cautious of, which I find, at least in my experience with novice option traders, it's not a concept that they most readily understand. And so sometimes people are caught off guard where they are buying options when implied volatility is high, and then they fail to recognize that when the environment changes again and there's a decrease of implied volatility, we get what we would refer to as a contraction. And that's really essentially just an environment where the market is no longer concerned about as concerned about the uncertainties, and as a result, the option contracts begin to be priced more in line with the historical volatility of the underlying security. So in that instance, if we take a look at the implied volatility distribution curve here, what might happen then is that the option prices will be adjusted such that the market maker feels that the stock is only going to trade between 47 and 53, or there's a 68.2% chance that it's going to trade within that 47 to 53. So where that becomes a very important consideration for us is that if we bought those option contracts when implied volatility was high, and we subsequently anticipated the stock was going to move, and even if the stock moves but implied volatility contracts, we might be right about the movement of the underlying security, but we may actually not make any money or even perhaps lose money because the contraction of the implied volatility has essentially decreased the value. So it's important, and again, I'll encourage you guys to watch the Options Greeks video where we talk about just how the different pricing variables are influencing the premium, because what happens, as an example, is the option contract may adjust higher because of the option delta, but because of the contraction of implied volatility, that adjustment lower may completely wipe out all the benefits of being right about the move in the underlying security. So it's important to be cognizant of just what the implied volatility of the options are comparative to the historic volatility, so that you can then make a better decision as to what strategy may be the most important. So as a general rule of thumb, during periods of low volatility, call and put options are what we would consider to be cheap from a historical perspective. So in other words, we would basically look at being more of an option buyer because we're able to go out and buy longer term options at a relatively reduced cost, right? And we could in fact even take advantage of an increase of implied volatility. So think about what we're trying to do. If we recognize that the implied volatility is low currently, we could have a directional view on an underlying stock, and we could buy that option and not only benefit from an increase in the underlying security, which would be influencing the option contract, but if on that movement we get an increase or an expansion of implied volatility, that will also work in our favor as well. So we're basically putting two of the option pricing variables in our favor when we recognize, when we're right about the directional bias, but we also recognize what the volatility state is of the contract. Now, for the option writer, so for somebody who is looking to generate cash flow utilizing options through covered call writing or put writing, which we're going to talk about here shortly, this means that we're getting less premium. And so in order to, we're in a high implied volatility environment, we'd be selling, let's say, out of the money options because premiums are attractive out of the money, and we can also benefit from an appreciation in the underlying security. During periods of low implied volatility, we actually end up utilizing more at-the-money options, so we give up less stock upside in order to get more premium. So Nigel just had a question about screening for implied volatility. You can actually see, and I'll be referencing a slide here shortly, where you'll be able to see the implied. If you go to the Montreal Exchange site, you'll be able to see within the option change the implied volatility of each of the contracts. But your trading platform as well will have a reference to that, depending upon just how familiar you are with the tools. And further to that, I found that the Chicago Board Options Exchange, the CBOE website, actually has a great free tool that you can utilize that'll give you both implied volatility measure of Canadian and U.S. Options. So that's at cboe.com. So there's a few resources out there, Nigel, that you can access, but you can get information from the MX site or from your own platform as well. Now, during periods of high implied volatility, as I mentioned, call and put options are expensive from a historical perspective, and that's where, as the option buyer, option premiums are higher, and therefore the risk of loss is a much greater consideration in the event of a volatility crash. And that's very, very important, because I've had a lot of people in the past where they've sort of missed the importance of implied volatility. Have said, well, I was right about the stock. Stock went up in my direction, but I lost money on the position, and they think there's something wrong or rigged with the options market, when in reality it's simply just based on the way the options market trades. Maybe they bought the option when implied volatility was high, and again, even though they were right about the stock direction, you add an implied volatility collapse, and it's cost you. But for the option writer, that actually is a good thing. So one of our key strategies that we'll look to take advantage of is, let's say we've seen a significant sell-off from a stock. Maybe it was a bad earnings report, and the stock really sells off significantly. But if we think that the company is still a very good company, what we'll do is we'll say, hey, you know what? We can own this company 10% lower. We can get a really juicy premium by selling the put option, and as a result, we'll look to take advantage of that sell-off through writing a put option that has a significantly increased implied volatility factor. Because what happens, of course, is once the dust settles and implied volatility contracts, as the put writer, we actually benefit from that. We sell at the high premium, implied volatility collapse, and then we could essentially buy it back at a lower premium and take advantage of this implied volatility contraction. So really, really interesting strategy to implement as the option writer. But many of us want to take advantage of using options to trade a directional bias. I mean, that's one of the great things about the options market, is we can actually use them as a stock replacement strategy and put up significantly less capital than if we were in fact buying the underlying security. Well, one really, really great way to offset the implied volatility variable is by utilizing debit spreads. And again, we got to remember that all of these option contracts and combinations are influenced by the mathematics of the Greeks. And so when we are combining option contracts, we're actually kind of messing with the mathematics, and we're altering the way the net combination will respond as market conditions change. So the idea of a debit spread, and again, we've got other presentations that dig much more deeply into these strategies, but as a general review here, what we're really looking to do is to offset the cost of the expensive option. Now, it might be expensive because the stock is just a real volatile stock, or it might be expensive because implied volatility has expanded. But the bottom line is we're trying to find a solution to decrease the cost of participation. So when we decrease that cost of participation, we actually reduce the break-even point of the trade, which I like, because what that means is the stock doesn't have to move as much for us to break even. So anytime we can, reduce, how much we need a stock to move in our favor, I believe that we're increasing our probabilities of being right and of being profitable. So I think it becomes a great consideration, to look at debit spreads. What it does as well is that it also, because we're reducing the cost of the trade, again, depending upon how much capital you're allocating to the position, but it does reduce the potential loss if the underlying moves adversely. So for example, if we were going to risk $1,000 to buy a call option, but as an alternative, we could risk for that same position $500, by utilizing a spread. Well, what we've done is we've reduced our break-even point, and we've reduced the potential loss if the underlying moves adversely. Now, the trade-off, and that's one thing we want to recognize with any option strategy, is there's always going to be a bit of a trade-off, and in this upside profit beyond the sold, or what I would refer to as the written strike. To me, that's fine, and you're going to see why as we go through the examples. But just always remember, there's going to be a trade-off, when you start creating combinations, and you've got to decide what the most important thing is you're trying to accomplish, and whether or not you can live with that trade-off. So we're going to use a bull call spread as an example, and so a bull call spread, we have a bullish outlook. And we're going to buy one call option that'll be close to where the stock's trading at presently, and then we're going to sell another call option with a higher strike price. In this case, they're going to be the same expiration date. So I was looking at Agnico just the other day when I was putting the presentations together here, and Agnico at the time was trading at $49.70. And I looked at the March $50 call option, and it was trading for $4.50. So there's one thing about these gold stocks we want to recognize, is that they trade with a very high implied volatility. So option premiums on gold stocks are pretty expensive. And so if we were to buy this call option outright, right, we would be paying $4.50. And that means our break-even point on the trade would be $54.50. And the stock has to be trading above that on expiration for us to break even. But in order to offset that, what we're going to do is we're going to turn around and we're going to go further out of the money to the $56 strike call, and we're going to sell that March contract at the 56 strike for $2.50. The net cost for the trade ends up being $2. So if we just take a quick look at what the options the options chain look like. If we're buying the March, and this was pre-market, so I went with the last price just to give you an idea. But if we went and we bought the March expiring option, we're going to pay $4.55. And I rounded up on the other side to the last price, and we're going to sell it for $2. I rounded down with the buy and rounded up with the sell, and ultimately, we got to our $2 price point. But what I want you to take a look at is the historical 30-day volatility. So the price action on the underlying stock is about 50%. It's pretty high, right? Because gold stocks are all over the place. And what you'll see here is that also equates to a very high implied volatility. As the buyer, we are buying implied volatility. And so we lose if that implied volatility contracts. But as the seller, we're selling implied volatility, and we gain when that implied volatility contracts. So as you can see here, when we compare the two option contracts that we're utilizing, we're paying out an implied volatility of 47.4% with the long call at the 50 strike, but then we're collecting through the 56 strike premium an option premium with an implied volatility of 46.8 cents or 8%. So we are in fact almost completely offsetting the influence that any expansion or contraction of implied volatility will have on this position, which means that the two most influential pricing variables are going to be the delta, which is basically how much the option contracts are going to appreciate in value as the stock moves higher, and the theta, which is time. And the time value is always a negative influence, so time always is decreasing on a day-to-day basis. But in this case, we've offset the implied volatility variables. So when we take a look at the logistics of this particular example, our maximum profit is the spread minus the debit. Well, we bought the 50s and we sold the 56, and it costs us $2. So we've a $6 spread minus a $2 premium, and that means we have a profit potential of $4, which, you know, even though we've capped our upside profitable, if you do the percentage rate of return or the risk-adjusted rate of return, it's still pretty darn attractive, considering that we've reduced our break-even point down to $52. So remember, when we were paying $4.50 just to buy the call, the stock needed to move above $54.50 before expiration for us to just break even and profit. Here, our break-even point is down at 52, which means the stock doesn't have to move as much in order for us to be correct. And our maximum loss has been reduced from the cost of the call option exclusively. It's been reduced down to the net combination, the long call purchase minus the short call collection or credit. It brought us down to a maximum risk of $2. So bear put spreads essentially have the same logistics, except we're of course going to reverse engineer. We're going to use put options, and we would buy one put option and then subsequently sell another put option at a lower strike. But the principles are essentially the same. We're going to use the same expiration date, but the principles are the same. What we're looking to do is we're looking to reduce the cost of participating in that bearish outlook by using the sale of the further out of the money lower strike to offset the cost of the at the money strike. Now, when it comes to selling volatility, I want to just take a look at a comparison of between selling covered calls and selling puts. Now, again, as I mentioned, during periods of high implied volatility, call and put options are expensive from a historical perspective. Well, as the option writer, we can take advantage of that, right? So that means that we can go further out of the money and sell options and get a decent premium. So when we look at the covered call strategy, and again, I'll just once again remind you that there are other presentations in the archive that you can review more specifically for these strategies. But just as a quick sort of general overview of the covered call strategy, this is where we either buy or we already own the stock, and we're going to sell one call option for every 100 shares. What we're doing is we're basically getting paid to take on the obligation to deliver the stock to the option buyer at a specific price and over a specific time. So the reason why the option premiums would be more expensive or implied volatility would be higher is that the market thinks that there's a higher chance that the stock is going to be trading at or above the specific contract. So what we're taking advantage of is selling that premium, and in this case we need to be comfortable with delivering our shares at the specified price, because we're getting paid a higher premium because there's a higher probability. So remember that a higher premium, when implied volatility goes higher, it means that the market thinks there's a higher probability that the stock is going to be trading above or below that particular contract. So just to circle back to an Eagle here, and I just averaged up to the to $50 per share. We're going to buy 100 shares and put out $5 grand. Now the 3-month 52 strike call option is trading at $2. It has an implied volatility of 40 cents. So basically, under these conditions, if we sold one covered call for every 100 shares, we're going to collect $2, or almost about 4% for to take on the obligation to sell 100 shares at AEM over the next 3 months at $52. Now, understand I chose these gold stocks. They have a huge implied volatility premium built in, so don't expect you're going to find this kind of return off of your typical bank stocks or some of your less volatile stocks. But gold stocks tend to have a higher premium, and as a result, you get paid a little bit more significantly for selling options on those particular stocks. But more importantly, what I want you to recognize is that if we went through the same scenario, but in this case, implied volatility increased to 45%, so we had a $5 increase in implied volatility, we're actually able to increase our return from $200 to $230, which is essentially another just over 0.5% increase in our return, right? So you got to recognize again, 0.5% here, 0.5% there, that all adds up. So just understand that when implied volatility increases, we can then sell option contracts and generate a greater rate of return for our efforts. So just that 5% increase in implied volatility added an extra 0.5% return to the strategy that we were implementing. And keep in mind as well, folks, we can also benefit from, if we bought the shares at 50, in both cases we still get to benefit from the difference between 50 where we bought it and the 52 strike where we're obligated to sell, right? So we can also sell put options as well, and I sort of mentioned this earlier on, where an interesting approach is to look at selling puts as a way to assume stock ownership. So remember that when we sell a put option, we are collecting a premium, and we are and as a result, when we sell a put, we are taking on the obligation to buy 100 shares for every put option sold, and we're getting paid to do so. And so if we're looking at a stock that we really think we'd like to own, and let's say it's been significantly beaten up by the market, implied volatility may be fairly high, and so we might be able to take advantage of that increase in implied volatility, plus be able to purchase that particular stock at a price that we feel is of better value. So an example that I was looking at as well just the other day is Acon Group, so in infrastructure, symbol ARE, and at the time it was trading at $15.40. Well, the 1-month put option is trading at 45 cents. Now it's a little bit lower implied volatility, as you can see, than the gold stocks, but nonetheless, with an implied volatility at 25%, we could sell 10 puts. So, for example, we're going to buy 1,000 shares, and we're going to sell 10 put options. So ultimately, we're going to collect $450 to take on for the obligation to buy 1,000 shares of ARE over the next month at $15. That actually equates to a 3% return in 1 month. Now, that option contract is fairly close to the money, as you can see. So basically, there's not a lot of downside before we may be, may have to take on the obligation to own those shares. But if the shares just stayed the same and that put option expired, as you can see, we can make a fairly decent return. If that stock had suffered a significant drop, for example, and under the same circumstances, let's say implied volatility increases from 25% to 30%, we actually can pick up an extra 0.5% once again, just by recognizing that it was an ideal time to sell the puts, right? So one of the strategic approaches to option writing that we implement is just being cognizant of what's happening within that underlying stock and looking for stocks in certain circumstances that are on our buy list, that are fundamentally strong. Subsequently reviewing the earnings to see whether or not there's any far-reaching ripple effects to what they released. And then looking at the option contracts and say, hey, you know what, the investors are just we believe investors have overshot to the downside. Implied volatility has expanded. Let's go in and take advantage of this by selling put options, because what you want to recognize is when you sell that premium, let's say I sold that premium and I was able to collect let's say 50 cents per contract. Well, what that means is if I buy the stock for $15, but I've collected 50 cents, my cost basis is reduced down to $14.50. And then once I take possession of those underlying shares, as the stock starts to maybe move higher, implied volatility on the calls will increase, and I can implement a covered call writing strategy. So there's lots of ways that we can, maneuver around these strategies to take advantage of market conditions and sort of, again, just deploy strategies to get in. We can sell the puts. Once we take possession of the stock, we can turn around and sell the calls and just continue to manage accordingly. So we're going to have an opportunity, obviously, to answer some questions over the next little bit. But one thing that I just want to reinforce is just the importance of understanding just how significant the impact of implied volatility is on options pricing. When you actually are able to identify changes in implied volatility, this is going to help you with strategy selection, and it's also going to help you understand, and manage your performance expectations and expected returns on positions that you've implemented in the market. Just a quick reminder, folks, there's a lot of information that you can find at the on the Montreal Exchange website. We've got our blogs, and actually a really nice update to the blog site at optionmatters.ca. So I encourage you to get over there and check that out. We've got option trading newsletters, videos and webinars, trading guides and strategies, calculators, for covered calls and just option strategies in general, and a great little options trading simulator. So feel free to find that information at m-x.ca or m-x.tv. And I'll pass it back to Rose to moderate some of the questions. And as I said, we got quite a bit of time here left this morning if anybody wants to ask away.
Thanks very much, Jason. So I'm just going to do some closing remarks while you type in your questions in the question panel. You can access our webinar's recording on our website from next week on, and also don't forget to submit the short survey that does pop up after you exit today's session. And also mark your calendars. We have the market guys joining us this Thursday, December 22nd, our very last webinar of the year, to present on role reversal patterns. And Montreal Exchange is back with us in the new year on Tuesday, January 24th at 1 p.m. Eastern Time to present on advanced options strategies. And you are also welcome to sign up for our other webinars on our seminar and webinar calendar under the Learn and Do More section. And also, again, past webinar recordings can be accessed on our webinars on demand page. And I'm just going to check our Q&A panel to see if there are any questions submitted. Okay, I think, Jason, you already addressed the ones from Nigel, so that should be okay. And James is asking, can we get a copy of the presentation? And I will make that available to you in a few seconds. And if there are no other questions,
Nigel just had a follow-up question about how one would set up a bull spread on tech. So I mean, basically, and again, not a recommendation or an endorsement of the strategy, but what you would look to do on your platform is buy the call option that you feel, or put bull spread, or the call option that you want to enter into the position with, and then subsequently you have to use a separate transaction, but then sell the call option out of the money at a spread differential that you feel makes the most sense. As a general rule, the way I look at sort of benchmarking what constitutes a a good spread opportunity is if I could actually put that spread on for 50% of the actual spread differential. So for example, if I was looking at a $5 spread differential, then I don't want to pay any more than $2.50 net for that combination. So hopefully that helps you. I see Shane's got a question as well, if you want me to address that, Rose.
Please.
Yeah, so Shane's just want to know what would I say is the biggest advantage to using put and call options over simply trading the stock, just more as an insurance policy to minimize losses and gains. Well, number one benefit is, I believe, as a stock replacement strategy, is actually there's two very, I think, important benefits. One is the ability to leverage your capital significantly without without significantly increasing your risk. So you could control $1,000 of an underlying security for $200, for example. So for people that have a limited account size, but they're still looking to generate a reasonable exposure to the underlying stock, the call option or put option as a stock replacement strategy becomes a great solution. The other is the limited and defined risk. So when we buy a call or when we buy a put, you cannot lose any more than the premium that you've paid, which means that, I'll give you an example. If we buy a stock at $50, let's say we're looking at an Eagle, and we buy it at $50, and all of a sudden, gold moves significantly overnight to the downside, and we see a $5 drop in an Eagle. Well, if we own the stock, we're down $5. If we were able to reduce our cost on the options, let's say using that spread, our maximum risk on that trade is only $2, and even that's not fully recognizable until expiration. So we have a defined risk that no matter what happens, no matter what madness ensues overnight or pre-market, we know exactly what it's going to cost us if we're on the wrong side of it. And again, not to mention if we're using, we can use puts as an insurance policy as well. So that that's another way that we can use as a hedging opportunity. James just had a question about the options trading letter available at the Montreal Exchange site. Really, just on a quarterly basis, there's a newsletter produced that sort of outlines some various strategies and market observations that you as an investor can take advantage of, and maybe gain some insight and perhaps even some ideas towards the market and integrating options as a solution. I guess, Rose, there's a question regarding brokerage platforms, and maybe you want to comment on that one from Susie.
Okay, thanks, Jason. This one's actually I'm going to have to take offline, and I'll give you the answer directly by email, Susie.
Perfect. All right, so then Shane just had a follow-up question. What would I recommend for someone just trying to get their feet wet in options? So Shane's just indicating, probably not unlike a lot of folks, that they really just trade stocks. He's quite active, but he wants to expand his knowledge. I think first and foremost, these webinars are a great start, and repetition and reinforcement, I think, is key. I can tell you that that's really the only way that I learned, is just by, well, there weren't actually a lot of webinars when I was learning, so it was just a lot of reading and researching and that sort of thing. But and then further to that, trying to take advantage of the simulated trading platforms. And a lot of times people think, well, I don't need that. I'm an adult. Why do I need to use a simulator? But you know, I'll reference the one at the Montreal Exchange, which you can access by visiting the site. It's a great way. You just put your name and email in, and you can get set up, and you can implement all of these strategies that we've talked about, and then you can come back on a day-to-day basis to see where they're at and manage accordingly. And it really just gives you a good feel as to how to execute a trade, how to monitor a trade, and then subsequently how to manage out of the trade without putting up your own capital. So, and start simple. Buying a call, buying a put option as just a way to start clicking the buttons is a great start. Spread strategies, I think, from a directional standpoint, is your next step, but don't feel you have to rush into it. And then finally, the covered call strategy to me is a fantastic bread and butter strategy for somebody who's somebody who wants to take their investment portfolio management to the next level and enhance their income. What I would say, and again, this is my own opinion, is I'm not a big fan of day trading options. So if you're somebody who is actively day trading stocks, that's one approach. But I like options for more of an intermediate term, for more intermediate term opportunities. So, for me, over a couple of months, well, you close out when you hit your targets, but you're buying the options to participate conceivably for a couple of months on a bigger picture move to the upside. So that's my 2 cents anyway. So hopefully that helps out. Charbel just had a question about being new to options and when buying a call option, is the contract always good until the expiration date? So one of the things we want to realize when we buy a call option, or a put option for that matter, is while it will continue to trade and be available for purchase and sale until its expiration date, depending upon what the underlying stock does, it may not have a heck of a lot of value. So you are really, your objective is when you buy that call or you buy that put, that the stock is going to make a move in your anticipated direction well within the time frame that you've allocated. If the stock doesn't move as you've anticipated and it is trading below the strike price of the call or above the strike price of the put on expiration, it will expire worthless. So a call and a put as a buyer is a depreciating asset, and you need to have either the stock move in your, you need to have the stock move in your favor, and ideally implied volatility expand, and then manage for your profits accordingly. So hopefully that answers your question. And I think that's it, Rose. I don't see anything else trickling in here.
I don't see any either. Thank you, Jason. And for those of you that may not have noticed, the handout is now available in your control panel, so just feel free to download that. And thanks again, Jason, for joining us and sharing your insights. And thank you all for attending, and hope you have a good rest of the day. Take care and have a great day.
Thanks, folks, and happy holidays.
Sorry, I'm just going to follow up. Shane, you do have a question for me about the webinar list. If you go to our website on Scotia iTrade, and then the Learn and Do More section, in that area, there's a left navigation that says Webinars on Demand. I'll actually email it to you directly so that you'll have reference to it. So I'll take that offline. Thank you.